Today, we're digging into a detailed analysis of NFLX, or NFLX, which argues for a strong buy at around $94, projecting a huge 40% upside to over $133 by 2026.
And that upside is driven by things like the ad tier expansion and live events. So let's jump right in.
Yeah, let's do it. So as I understand it from the notes, the basic argument is that the risk-reward ratio at $94 is just, heavily skewed to the upside.
It is, and this analysis is undeniably powerful. It identifies these really concrete catalysts, the ad tier money printer, the WWE effect, and it lays out a very clear thesis.
Right.
But, and this is the big but, when you're calling for a strong buy and a 40% jump, that analysis has to be, let's say, structurally resistant to any skeptical attack.
It has to be bulletproof, exactly. And we see opportunities to really maximize its credibility, and that starts with the defense, the risk analysis. It makes sense. I mean, if you're recommending a back-the-truck-up buy zone, which is a pretty aggressive entry,
it is.
Then you have to show that you've thought about every single roadblock that could stop that truck.
The assessment of downside risk, while it is mentioned, requires a much more dedicated analytical depth to ensure the report's robustness against, negative market shifts.
Okay.
This isn't just about disclosure, it's about building confidence. Right now, the risks are they're listed as these generalized factors. Things like ad tier growth slows down or a general market recession.
Which feels like a generic disclaimer, not a real analysis of the specific threats to NFLX.
Precisely. The weakness here is that lack of specificity. I mean, the report spent pages detailing the mechanics of the bull case, WWE, ARPU stacking, all of it, but the risks feel like this boilerplate afterthought.
So if you've done the work to project a 40% return, you also have to do the work to show why that thesis isn't going to just fall apart.
You have to. The suggestion for improvement is to integrate specific, quantifiable counterarguments. And they have to be related directly to those primary catalysts, the ad tier and live events, to create a more sophisticated and, frankly, more balanced risk-reward matrix.
Okay, so how do we do that? How do you turn a general risk, like competition, into a specific, quantifiable counterargument that actually challenges the financial model?
Great question. Let's take the ad tier success as an example. So the report makes a strong case for high-margin ad revenue.
Right.
To counter this, you have to model the financial impact if increased competition from, say, Disney or Amazon limits Netflix's premium ad pricing power. Don't just say it could happen.
Quantify it.
Quantify it. Show how much ARPU growth might get shaved off if they're forced to compete on price. You could model a scenario where, 2026 ARPU projections get reduced by maybe 15% because the market just gets saturated.
That's super actionable. It shows the real financial consequence of competition instead of just, mentioning that it exists. So what about the content side of that?
Same principle. We need to analyze the sustainability of the WWE effect. So you should address the unavoidable content cost inflation for getting future exclusive live events.
Okay.
And then model a worst-case scenario where new live ventures just don't reduce churn as effectively as you hoped. For instance, what happens if content costs increase by 12% year over year, but your subscriber retention only improves by 1% instead of the 3% you projected?
That kind of stress test is what justifies a 40% projection. If you can defend the downside with actual numbers, the upside suddenly looks a lot more credible.
Exactly. Okay, so that's the risk side. Let's talk about the reward. Let's look closely at the section discussing the ad tier money printer and how we get to that final valuation target of $133. Because, how do we make that bridge from operational success to that price target less of a leap of faith?
This is probably where the most structural reinforcement is needed, because it ties directly into the credibility of the whole investment thesis.
I'd agree. So the pathway from the qualitative catalysts, becoming a digital advertising giant, to that specific 40% valuation reset needs clearer step-by-step documentation.
Yeah, the narrative case for growth is really strong. We believe the ad tier will succeed, we believe in the live events, but that quantitative jump to $133 just feels a bit abrupt. Where's the math connecting the dots?
Well, that's the weakness. The connection is implied, but it's not actually demonstrated. The report asserts that operational success will justify the target, but the quantitative bridge supporting that jump it's just missing.
And for a price target that high and that specific, an investor's going to need to see the work, right? Especially when the current PE ratio is already up around 39x.
That's the core question that needs to be solved. So the suggestion is to create a sensitivity analysis Or maybe an explicit modeling section that bridges that qualitative narrative with the quantitative endpoint. You have to show the mechanics of the multiple expansion.
Okay, so why should the market give Netflix a substantially higher multiple in 2026 than it does today, just because they successfully added an ad tier?
That is exactly the point, and here's how you can demonstrate it. First, explicitly define the implied multiple. State the required 2026 PE ratio you need to get to $133.
Okay.
Let's just say that number requires a PE of 50 times your 2026 estimated earnings. You then have to justify why the market would award NFLX that much higher multiple, specifically because of the stability and the high margins of ad tier revenue.
So you could argue that ad revenue is so predictable, it deserves a multiple more like a software platform, not a traditional media company.
You could. That sharpens the argument immediately. It shifts the discussion from growth will happen to this type of growth justifies a specific superior valuation.
Okay, that's one piece. What's the other?
The second piece is to model the catalyst impact directly. Build a projected model. If the ad tier captures, say, 15% of the linear TV ad market by late 2025, and WWE cuts churn by 5%,
You show exactly how those two variables combine?
yes, you demonstrate precisely how they combine to drive the necessary free cash flow or EPS growth you need to back into that $133 target. You show the mechanism, not just the end result.
And doing that really elevates the analysis. It goes from being a persuasive essay to a comprehensive, mathematically defined investment case.
Right. It eliminates the doubt.
Okay, so we've covered the reward, we've covered the risk. Let's look at the entry point. A key theme running through this material seems to be the very specific technical levels you provide, like that $90 to $92 back the truck up zone.
Yeah, the technical analysis is clear, it's actionable, but it's also structurally independent from the fundamentals right now. This is all about cohesion.
Okay.
The technical analysis section, while it provides these clear buy zones, would be so much stronger if it explicitly linked those price support levels to the company's, stated financial health and cash flow strategies.
I see that disconnect. So the weakness is that the aggressive $90 to $92 buy zone is justified with this kind of vague generic charting language. It says strong institutional support.
Which, while true in charting, it's not enough. Especially when the report has already established these powerful fundamental reasons for price support, like massive free cash flow and an active share buyback program.
And those two concepts are just totally disconnected from the technical map at the moment.
They are. We need the report to speak with one unified voice. So, the suggestion for improvement is to make sure that technical mapping is grounded directly in the fundamental evidence. You're transforming chart levels into strategically defensible financial positions based on actual corporate actions.
So how do we make that concrete? How do we turn institutional support into financial defense?
First, you quantify the buyback floor. You've already mentioned the share repurchase program in the financial check.
Right.
So relate that $90 to $92 zone directly to that program. Instead of just relying on a chart pattern, maybe you can note that this range represents a specific free cash flow yield target that institutions prioritize. Or maybe it's a level that implies management's historically aggressive buying threshold.
That's a much stronger signal. Instead of just saying big players buy here, you're saying Netflix's own balance sheet and its own strategy dictates support at this specific level.
It's fundamentally defensible. And a second point is to connect liquidity. Detail how the increased liquidity after the stock split directly supports management's ability to execute that FCF strategy. It makes share buybacks more efficient at the current price.
So by linking FCF and the buybacks to the technical map, you're reinforcing that aggressive entry zone as fundamentally sound. You're showing the level isn't arbitrary.
Exactly. It's a reflection of corporate commitment to protecting that floor.
This analysis is really built on very strong bones. It articulates a clear, high-conviction thesis for, a major player in the streaming space.
Absolutely. The identified catalysts, the ad tier, the move into live events, those are clearly the high-impact drivers. This is a very compelling report.
It just needs its quantitative defenses shored up to match the ambition of that 40% upside target.
That's the perfect way to say it.